When it comes to transfer duty, it is relatively easy. We say that transfer duty is payable on the acquisition of fixed property. However, sometimes VAT will apply. And if VAT applies, transfer duty can never be payable. To determine when VAT is payable rather than transfer duty, one always has to look at the seller. As with a normal shopkeeper, if the seller is a registered VAT vendor, VAT will be payable on the purchase price and must be included in the purchase price. So it's extremely important for estate agents and sellers alike to realize that the seller remains responsible for payment of VAT, and this should be determined upfront before the agent starts marketing your property. If you sell your property for 1 million rands and it later becomes clear that VAT is payable on the transaction and not transfer duty, the purchaser can insist that that property has been sold to him for 1 million rands and that the seller will be responsible for payment of the 14% VAT to SARS, even though the purchaser will now not be liable for transfer duty anymore. So it's extremely important. Where we said that the purchaser is liable to pay transfer duty, VAT is always payable by the seller, and this should be negotiated upfront. Once we've determined that VAT is applicable, we have already mentioned that transfer duty is then not payable. To determine whether VAT is applicable to a transaction, we have to apply a twofold test. First of all, the seller must be a registered VAT vendor. In other words, he must have a registered or VAT registration number. Secondly, he must also be a VAT vendor pertaining to the property in question. It's not just enough to establish that the seller is a VAT vendor. I am a VAT vendor because I am an attorney. But I'm not a VAT vendor pertaining to the property in question if I sell my primary residence. That has got nothing to do with my VAT business. So that's why I say that the test is twofold. You have to establish, one, that the seller is a VAT vendor or registered for VAT purposes, and that he is a VAT vendor pertaining to the property in question. In this regard, one should always check where the seller uses his property for business purposes, whether he works from home, whether he lets out that property, and VAT is payable on the monthly rental, whether it's a guest house. These are the dangerous areas that we always should check for and establish beforehand whether the seller is in fact a registered VAT vendor. Once we have established that the seller is a VAT vendor pertaining to the property in question, in other words, the property that we are marketing or selling, we then could look at the possibility of zero rating the transaction. This means that the receiver of revenue will realize that the seller will pay 14% VAT over to SARS on registration of transfer, but if the purchaser is also a VAT vendor and who is also going to earn income, VATable income, as far as SARS is concerned on that property, the purchaser will be allowed to claim the 14% VAT, which he paid as part of the purchase price. He will be able to claim that 14% back from SARS. So the net effect for SARS is zero. And for that reason, they will allow zero rating if certain requirements are met. These requirements must be met and must be contained in the deed of sale before SARS will allow zero rating to apply. The requirements are as follows. 1. Both parties must be registered for VAT. If the purchaser is not a VAT vendor, why would the receiver allow zero rating to apply if the purchaser was not able to claim the VAT back in any event because he is not a VAT vendor? So the argument is both parties must be registered for VAT. That must be contained in the deed of sale. Secondly, the purchaser must buy the property as a going concern, meaning that he will continue the income earning activity at the property. So if it's a property that is used for rental purposes and that is being let to a tenant, the purchaser must continue the letting activity, because this is how SARS actually gets the VATable income. He gets the VAT on that rental income every month. So if the purchaser is not going to continue the income earning activity, why would SARS allow zero rating to apply? Because they are not going to earn VAT every month. So that is the second requirement, and it also must be contained in the deed of sale. Thirdly, it's extremely important to mention in the deed of sale that if for any reason VAT is payable at 14% instead of at a zero rate, that the purchaser would pay such VAT over and above the purchase price. Because in our previous example, if the seller wants to sell the property for 1 million rands and he wants it to be zero rated, if the receiver of revenue now turns around and says VAT is payable at 14%, we said right at the beginning that the seller is always liable to pay that VAT, just as the shopkeeper is liable to pay VAT on sales every second month when he does his VAT return. The seller will be liable to pay the 14% to the receiver of revenue, which means that he will not get 1 million rands in his pocket. He will get 1 million rands less 14% payable to the receiver of revenue. So we want to insert a clause in the deed of sale that stipulates that if for any reason SARS doesn't allow the zero rating, that the purchaser will pay the 14% over and above the 1 million rands. The seller will then pay that 140,000 rands over to the receiver of revenue on date of registration, and the purchaser will merely be able to claim the 140,000 rands back after registration of transfer. So we need to protect the seller where SARS does not allow zero rating to apply, and it should be contained in the deed of sale.